Well, let's talk more about the markets in this final trading day of a shortened week. Joining us are Tom Lydon, president of Global Trends Investments, and Joe Arnold. He's an investment advisor at Dawson Wealth Management. And with us for the hour, Andy Bush, global forex strategist at BMO Capital Markets and a senior fellow on economic matters at the Illinois Policy Institute and a CNBC contributor. Well, let's start off, if we can, with Joe. We're just going to go alphabetically by last name here. Joe, you're the bull, disclosed bull in the trio. Why so bullish as we go into '09?
Well, I think there's three separate factors that we're looking at. Number one, we really like what's happened with the Federal Reserve and with the government and the TARP program. We're seeing that credit is starting to become unfrozen. We're seeing liquidity back into the markets. Number two, we really like what's happening with the auto industry. I think that was a major factor in what's going on with the economy because we are seeing some help given there. And number three, probably the most important, we're seeing that stocks are just extremely oversold and there's a lot of value right now.
Now, I mean, you've certainly awakened the bear from his hibernation. Let's bring in Tom Lydon. Tom, you're a bit of a bear, not even a bit of a bear, but a full-on bear. How come?
Well, hi, Matt. Well, Joe, you know, I hope you're right, but unfortunately with all the negative news, the negative GDP, unemployment numbers, housing numbers, and the terrible retail sales that I know we'll be watching in the next day or so, it's devastating for Americans, it's devastating for investors. And as you look into '09, we're going to look at a terrible fourth quarter for GDP, and then next week we'll also be talking about earnings numbers for the fourth quarter, which many feel are going to be way worse than expected. So right now, if you're an investor, it's not giving you a lot of confidence to pull that cash from underneath the mattress and go buy goods or go buy stocks at this point.
So, Andy, let you be the arbiter of bull and bear here as the Forex sort of overlord of the thing.
Sure.
Your reaction?
Well, I would say they're both right, but it's also the sequence of how it's going to be. I would say short term, the discussion about Obama's stimulus plan has been very positive already. We've already seen stocks rally something like 25% off their lows made back on November 21st. But the problem is all of these short term or all of these solutions that we're getting, whether it's the Fed or in a stimulus plan, are short term positives, long term negatives. And that's really where we're going to have problems later in the latter half of 2009. So short term, we've seen a positive bounce. We've seen some good things happen. Longer term, it's really going to cut off the top end growth rates for a lot of companies in the economy.
Well, let alone when the bill comes due for that growth in government. I'm starting to feel a little bearish here, Joe. Are we going to turn you around?
No, I think that we're going to stay positive. We really have to look at what our long-term investors are in the game for. And we look to see, you know, the average recession lasts 13 to 15 months, and we're getting to that point. This one may last a little bit longer. But again, as I said before, for our long-term investors, we feel the prudent approach is to be, you know, spread across the board in all sectors and really look to what a person's risk tolerance is and go from that point.
Well, that's the problem. If we had parallel stock markets where the long-term investors just could go in and be left alone and buy the L class of shares and the short-term traders could buy the T class, it would be perfect. Be a perfect world, wouldn't it, Tom?
Well, it would. And you know, the bottom line is long-term investors have lost patience. And we're all banking right now that as soon as Obama gets into office, that he's going to have some type of magic dust that he can turn this whole economy around with. And frankly, it's just not going to happen.
That's right. And I would say this. Here's an interesting fact. The last time bond yields, 10-year bond yields, fell below 3%, they stayed there for 24 years. So that, of course, was during the Depression through the 50s. But the point is this, is that people will not return to the stock market in the same way that they did back in 2002, 2003, and perhaps in the early 90s as well. I think this recession is going to be a little bit longer than the average recession. And that's going to be the big challenge going forward, to see how long this persists into 2009. Because if it extends beyond the summer, then it's going to be very difficult for stocks to maintain any kind of rally, obviously.
Go ahead.
That was my point, really. Just the thing that concerns me is really latter half of 2009 into 2010, as the government reaches into our economy and into the private sector and starts dictating what banks lend to each other, or banks lend to different sectors, or who's a bank holding company. So that's pretty disconcerting.
Tom, I thought I heard Tom jumping in there, but I think I'll just jump in here. If you talk about the duration of the recession and you look at history, then clearly there will be some sort of a bottoming. The bet would be a bottoming of the economy at some point in 09. But the what-if scenario always looms, in that we might be entering unprecedented territory. So what is the smart money move here, Joe? How do you hedge?
Actually, if you look for a hedge factor, I think number one, as was stated earlier, if you look at the spread between treasuries and municipal bonds, I think that's a good, safe play if you go with short-term, highly rated municipal bonds, especially for the higher net worth investor in their taxable accounts. And number two, also for a hedge factor, we look at managed futures as well, which tend to perform.
You don't think the Treasury market is the next bubble?
I think the jury's still out on that.
All right, you'd steer somebody into Treasury. All right, Tom, real quick, only 20 seconds. Where's the safe money, the smart money right now?
Yeah, I think Treasuries are fine right now, even though they're not paying that much. It's fairly safe, and everybody's keeping their powder dry. That's important. The other thing is currencies. The Swiss franc ETF has been up 10% in the last month. It's a great currency in times of uncertainty like this. And then finally, one win that Obama's going to have is in biotechnology. The iShares NASDAQ Biotechnology ETF should do well in the next month as biotech gets more attention.
You can't raise the Swiss franc with not getting Andy Bush fired up. But we're going to keep him around. But Joe, appreciate it very much. Tom, thanks for joining us on the call here this morning.
Thank you.